A very good morning to everyone here. Good morning, Ivan. Good to see you again. I'm just going to give a few more minutes for some more attendees to make a show, and then we'll get this underway. Okay, so from me and the FP Markets team, thank you all for taking the time to be with us. As the chat box is relatively empty, I assume we can all see the welcome slides and hear the audio nice and clearly. So look, for any of you who are new to this series, my name's Aaron Hill and I'm part of the research team here at FP Markets. Now, given the combined experience of our team, and we thought it would be a good idea to conduct a webinar that allows attendees to simply ask questions rather than a small 10 to 15 minute segment at the end of our usual presentations. Please please be aware that I'm certainly not George Soros or Paul Tudor Jones, so I do not know everything, so please do bear that in mind. If I'm unsure of the question, I will get back to you via email with a more detailed response. Okay, so just if you want to begin loading up your questions in the chat box while I run through the disclaimer, this would be fantastic. Please do bear in mind though, I am more technically focused, so questions directed this way are recommended. So as for the disclaimer, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. FP Markets does not give any warranty or representation as to the accuracy, reliability, or completeness of the information contained in this material. Okay, we have a few questions coming through already. That's fantastic. Right, okay. So the first question is, do I use the VIX? I do use the VIX, although it's not posted in the regular daily market analysis. So for anyone that's unaware, the VIX is designed to measure the expected 30-day volatility for the S&P 500 through the options markets. I do not trade the VIX directly through futures or options or even CFDs. However, throughout my studies, I have found that when the S&P does go into a decline, the VIX generally moves higher in magnitude than the market declines, if that makes sense. So there is opportunity to buy VIX products when stocks are in decline. I also use the VIX to judge market sentiment, which is very, very common. I think it will be easier for me to show a chart I have up. Just bear with me and I'll click across to the charts. Okay. So on the screen, I have the S&P 500 daily time frame and the VIX. Now, what I do differently, I believe it's different to many other traders, is on the VIX, I apply the Bollinger Bands. Now, the Bollinger Bands, so let me just reiterate this. So what I do is I apply the Bollinger Bands to the VIX to tell me when the VIX is overstretched to the upside and likely to retreat, and by extension, provide traders a long entry into the S&P or risk currencies, so like the Aussie dollar and New Zealand dollar. For newer traders unsure of what the Bollinger Bands are, it is simply a 20-day SMA with bands placed either side by 2 standard deviations. Obviously, you can alter those to 1 standard deviation or even 3 standard deviations if you so wish, but the default is 2 standard deviations. Now, look, standard deviation tells you how spread out or dispersed the data is. What this basically tells us is that for 2 standard deviations, 95% of the data is seen within 2 standard deviations. And any movement outside of these bands is considered extreme and likely to revert back to its mean. So the Bollinger Bands, for me, are a perfect fit to see when the VIX is likely to retreat and give traders an entry long into the equity market. Just really quickly, to calculate standard deviation, we simply take the square root of variance. Now, variance is found by subtracting the mean from each data point and squaring each of these results, and then finding the mean of these squared results. So, as you can see on the chart, as I've already said, we have the S&P 500 daily time frame. And we have the VIX on an equal on the daily time frame as well. But as you can see, I've applied the Bollinger Bands. Now, what you can generally see is when the VIX breaks out of the upper standard deviation, it generally does revert to the mean. So with this, we can, let me just zoom the charts out so we can see. So with this, so as you can see, we've broken out of the Bollinger Bands on the VIX, and this could be now, and what I do is I look for a close back into the VIX, back into the Bollinger Band, and then you can look for a long entry on the S&P. So as you can see, it lines up with, because as volatility expands, it has to contract at some point. So what I do is, so what you can see here, just to line up. So as you can see, the VIX price closes back into the Bollinger Band after closing outside of the 2 standard deviation extreme, and then generally reverts back to the mean. And as you can see, a nice long entry formed at this point here. Now, like everything in trading, of course, this is never guaranteed, but this is something I've found that's very, very consistent, especially with the VIX and the S&P, and also with risk currencies as well. I'll show these in a second. As you can see here as well, at this point here and this point here, let me just zoom in so we can see it a little clearer. Okay, at this point here, we strongly close outside of the 2 standard deviation Bollinger Band, and then we close back inside and we get a long entry into the S&P. Let me just mark those up so it's nice and clear. But yeah, this is something I use the VIX for. As I said, I don't trade the VIX through derivatives. Do bear in mind you can't trade the VIX directly, as it's not a tradable market per se. So yeah, as you can see, we have a strong correlation as when the VIX breaks out of its standard deviation, 2 standard deviation, and offers obviously long entries into risk assets. So if I just show you really quickly on the, so we have similar price action, obviously with other risk-based markets. As you can see, there would have been long entries in the Aussie dollar and New Zealand dollar at this point, and also around this point as well before it rallied higher. So are there any questions on the way I use the VIX to time possible entries into the risk markets? If not, I'll go on to the next question. Okay, excellent. So what's my favorite currency pair? I do not really have one, to be honest. I only trade the majors and minors. However, I've never really traded the exotics. So yes, I don't really have a favorite. I look at market action, and I base my decisions on that price action. As I said, though, I only do focus on the majors and minors. Okay, you mention Quasimodo supports and resistances often. Can you take us through them? Okay, I do actually have a webinar, two webinars, I believe, on Quasimodo resistances. But what I can do is take you through this. Let me just see if I can. Oh, there we go. This will be easier. So all the Quasimodo resistance is I see it as a fake out. You can give it all the names you want, but all it is literally a fake out, and price retests that fake out level. Now bear with me. I'm just going to draw this up. Now these are reversal patterns, by the way, but you can use them in dip buying and sell on rally scenarios as well. So they can be used to time entries into the trend, but they are considered reversal structure. Just bear with me. Okay. Okay, so we have the left shoulder there. So with the Quasimodo, we're looking at five points of contact. So the first point of contact is here, second point is here, third point, fourth point, and the fifth point is where we look to trade. So what you're looking at is a trade at this point after we formed a low below this the prior higher low. There's not really much else to say regarding this. A lot of people confuse these with head and shoulders, but what you do with the Quasimodo is you're actually in a lot earlier than a head and shoulders top in this case. And to be honest, no one in their right mind would want to trade a head and shoulders formation with a neckline facing this far south, because it would take price to close below here, and your stop would have to be, you know, above here maybe, depending on how aggressive you are, of course. Yes, so the Quasimodo, as I said, you can use the Quasimodo as a trend reversal pattern, or simply a way to buy into trends, or sell downtrends on rallies. But yeah, are there any questions on this? Now, how you can trade this area? So if you enter short at this point here, typically the stop is placed above the extreme peak of the above the extreme peak, so around 2 pips above the extreme peak. Now, if you do drill into the lower time frames at this point here, you will tend to find what I like to call the kink, and that's all that essentially is a supply area. So you will, let me just zoom in so we can see that a bit clearer. So what you'll see is price will come down and form a supply zone. So some traders I know that use this formation, they time their entry based on this supply around this line here, and position their stops above this kink, which obviously increases risk to reward exponentially. So there's not really much else I can add to this. It's quite a basic structure. There's not really anything complex about it. However, it's a very, very high probability pattern. Now, if the pattern fails to deliver a resistance at this point, and we break the extreme peak. Now, what you can look for, and I found these are very, very reliable levels, is what you can do is you can look for a reaction at this support. So it's essentially very similar to resistance turn support, as you would see in any market, but in this case, what you're using is the Quasimodo resistance. So we're going to break higher above the extreme peak. We come back down to retest the area, and we rally higher. I believe there was a few in the markets. Just bear with me. There was one that happened recently on the charts. I just can't remember which pair it was. Bear with me a minute. Here. Okay, this is the euro dollar. Let me just structure this. This is the euro dollar. Currently, this was my market analysis for for today, excuse me. And as you can see, we have the left. Let me just enlarge this chart. Okay. So we have the Quasimodo left shoulder here, 0.1, 0.2, 0.3, 0.4, and then obviously we failed to get a reaction at this point. And we broke higher and broke the extreme peak at this point. So what happens then is price comes down, retests that area, and forms support. Now, as I said, these have proven very, very reliable structures, but I do tend to find they offer the best scenario when price is not spent a long duration around from the break. So for instance, if we break higher here and we continue rallying, and then all of a sudden we turn and we're now in a downtrend, now you're going against the overall market sentiment, and this could potentially offer you a lower probability area. So this is one that worked out very recently, and this is the H4 time frame on the euro dollar. Now, just bear with me. Do you have, this is a question from Ivan, do you have actual stats for the higher and breakdown? Ivan, I'm not sure what you mean by that. Do you have, I understand, do you have any stats for the higher and breakdown? Do you mean, do I have any stats for when the Quasimodo fails, or for when the Quasimodo is retested as after it fails? Okay, let me just get back to this chart. So, okay, so look, so yes, Ivan said, is asking, do I have any stats? I do have some stats. I have backtested this within trending environments, do bear in mind. So I would never look, I did not test this to look for trend reversals. I looked at this. So for instance, we are in the S&P is a perfect example, right? I look for this to buy dips. I did test this, and it did very well. The average win rate, the average win percentage was around 65%, and the options to trail were immense because you're with the trend. So that's something I would advise if you're looking to buy into trends with this. Is obviously adopt a trailing stop. Obviously, the win percentage, the more the higher the reward you require, the lower the win percentage was. What exit rules did you apply? That's another question. So in the back test, the exit rules were a trail. So I did a few scenarios. I did where I took profits at 2R or the next area of decision. So that could have been so for instance, if I entered long at a Quasimodo support, I would take profit. I would ensure that there would be a take profit of at least 2R to the next decision point, so supply area or something like that. That was one. That was the high percentage one. That was where I got a really high percentage of trade. However, when I trailed the position, the win percentage did drop because I was looking for bigger wins. And I think the win percentage for that dropped to around 48% it was. But what I can say is the risk to reward was, the reward to risk was just incredible. Once you caught that trend, it's like everything. It's like when you're trading a trend following system, you're looking for that fat tail in statistics, right? You're looking for them large wins, that them 5R, 6R, 7R, 8R wins. And how I trailed was very, very basic. Was simply looking at the higher lows, the higher highs, higher lows forming, and then once price broke the previous high, I would place the stop just below the prior higher low, and that's it. Nothing more than that. But these are for me, they are proven areas of support and resistance. I find these a lot easier than traditional support and resistances, to be honest. But I wholeheartedly recommend these types of setups, as you saw in the euro dollar here. These are, you know, it's up to you how you exit these positions. Obviously, we're all different, but these types of setups, when the Quasimodo resistance breaks or the Quasimodo support breaks, and we trade the retest. But again, what you can do is look into this structure here. If there's a clear kink or a clear demand area or a clear a range that formed, you can use that range to base your entry and risk. So you enter at this point here and you place your stop below here. This is the difficult part for many people, because there's often just a clear break, like we saw on the euro dollar. I'll give you a demonstration right now, actually, because that's a perfect example. So as you can see, we broke higher. So what you could have done is, as we retested this area here as support, you could have put your stop below here. It's obvious, right? This is a clear decision point. What I mean by decision point is this area, excuse me, this area formed a decision to break through that resistance. This clearly has had power behind it. So this is an area of interest for me. When I say decision points, these are not, you could say these are supply and demand zones. I do understand that, but I look for a set structure of rules to define the decision point, and it has to make a decision. It has to be somewhere a decision was made. So this is a perfect example here, because we've broken out, and it's fresh as well. It's not connected to anything below here. It's not a reaction off of a resistance here. It's a completely fresh area. It reacted to this. It didn't even react to this area here. So it's a completely fresh area. It's a completely fresh decision point. Hence we come up. And look, price did come down and it provided support as well. So here we had so much confidence to enter long at this point. We had the Quasimodo resistance turn support plus the decision point at this area here. What you could have done in this situation is simply, as I said, enter long at this point here and place your stop below here. But if this was a clean break and there was nothing seen, no decision point or anything like that, what you can do then is simply go down to the, let's go down to the 30-minute first. And what you can do, see in this situation, it's a little bit difficult. See, there's this area here. So let's ignore this. So this area here. So what I would have been doing is working with this area at this point here. Now let's go back to the 4-hour chart. So as you can see, we now have an area to work with around that, which was pretty much invisible on the H4 time frame. So what you could have done is chose your entry level at the Quasimodo resistance turn support and place your stop below that area. All right, it's not much difference to placing it below here. I get that, but let's imagine there was nothing, there was no decision point here. Are there any questions? Ivan, did that answer your question regarding exit rules? Again, it's very subjective. Obviously, there's we can trail with the ATRs and things like that. ATR trailing stop. Okay, excellent, Ivan. Okay, so next question. Can you explain how you use the RSI? Yes, I can. The RSI is a it's a popular tool, very popular for good reason as well. This is my favorite out of the momentum oscillators. Obviously, you have the MACD, which is a combination, in my opinion, a combination of trend following and momentum, and you also have the stochastics. These are the most popular, but for me, I found the RSI to be the most easiest to understand in terms of calculation and in terms of interpretation for me anyway. Now, there are a number of strategies you can implement. I have a webinar on this as well on the RSI if you're interested. Just go to the FP Markets main webpage and look under resources, and you'll find the previous presentations there. So look, the RSI, let me just go on to the H1. This is the euro dollar again, if you want to follow along on your own charts. So let me kick off with, so I assume who asked this is pretty much a newbie with RSI, so I'm going to go over the basics. So between the 70 and 100 area is considered overbought. Now, overbought means that the upside pressure could be at its end, and a retracement could be in the offing, possibly. And so overbought is this area here. between 70 and 100, and oversold is between 30, as you can see on the, no, you can't see, between 30 and 0. Now, oversold is just the mirror opposite to overbought. This is when sellers are potentially overheated, or too much downside pressure, and it's likely to dry up. So with that, we have, so as you can see, price does, I'm not going to say generally, because it can, there are times when the overbought and oversold signals can prove very tricky to time, because in prolonged trends, overbought and oversold signals can be something we can be very difficult, as I said, can be very difficult to time, and the RSI can remain overbought or oversold for prolonged periods if we're in a strong trend. So what a lot of traders do is look for the RSI to exit. So this is the overbought. We look for the overbought, the RSI value to exit overbought, and again here oversold. Now what you can do is, I'm not going to go into this because it's a little bit too technical, I think. Is look for failure swings as well. All this is really is, I'm just trying to find an example of a failure swing. So there's one, I want a clear one for you guys. Here is a reasonably clear one, but so a failure swing is simply it is said that it's independent of price action, and you'll see why in a minute. So essentially we form an oversold signal. This is for an RSI failure swing bottom, and then we form a high, but we do not retest the oversold signal, oversold threshold. So oversold signal, high, failure to retest the oversold oversold threshold, and then we simply draw a line between here and the, excuse my artwork, and then we break, and then once we break higher, that's a signal to potentially enter long. Ivan says you can run an MA of the RSI itself. I've never done that. So you mean apply an MA to, that's very good. So instead of, that's a very good point. So what you can do, I'll just do that right now, actually. That's a very good point. Let me try to add an indicator to this. Can't remember how to do it. Let me just see. Okay, so look, what I'll do is I'll explain it. Ivan, do correct me if I'm wrong. But what Ivan's saying is apply an MA to the RSI and use that as a signal to enter long or short. So if you use an MA signal and price closes below the MA, we look for a bearish signal, and conversely, if the RSI value, yes, thank you, Ivan. So that's a very good idea. I've seen some traders actually do that. It just didn't come to mind. And then when the RSI value breaks above the MA, we have a long signal. So there's a multitude of ways of using the RSI. So we have the overbought, oversold signals. We have the RSI failure swings. Do look them up, or alternatively, do look at the webinar I conducted on the RSI. I go into detail with this. There's also divergences. I'm pretty sure most of us are aware of divergences. Now, with divergences, I see a lot of traders that take divergences in between this purple area here, so between the 30 and the 70 range. I personally do not like that. Now, that's not to say that traders who take divergent signals within that range is incorrect, because it's not. But I've personally found that the best signals are found when they are either within overbought or oversold. As you can see here, we had a clear overbought, overbought signal along with a divergence, a bearish divergence. Now, all divergence is when price and the indicator diverge. So as you can see, we form a higher high on the price chart, but fail to do so on the RSI chart. So what they're essentially doing is diverging and not converging. Also, there's the 50 center line threshold, which I don't really factor too much into my analysis. All the 50 center line threshold tells me is, all right, we've crossed above the 50 center line at this point. Now, what this shows, according to the calculation, is that average gains are beginning to exceed average losses. So what this means, this is a positive signal for traders, but it's not something I really factor into my analysis, to be honest. Yes, it's more just an indication. As I said, I don't really factor it in too much. Also, that one more thing you can use on the RSI, which I find very good, is you can also apply traditional technical patterns to the RSI. So, for instance, the common trend line resistance, we have a trend line support at this point here. Again, just with trend line support, some look for 2 points, some look for 3 points. For me, there's no right or wrong way. I found that 2 points are sufficient. I know of other traders that want 3 points, and that's fine. But look, we get a trend line break at this point here. You can also use support and resistance and things like that on the RSI. I hope that answered your question regarding how I use the RSI. Sorry, that was your question. I've just gone into an in-depth discussion, reasonably in-depth demonstration. Right. So how I use this, I really only look at the divergences, to be honest, that form within overbought and oversold signals. As you can see, I have resistance at this point here and support at this point here. So all this is, as you can see, is an area where the indicator bounced, so it's indicator support. So yes, I only look for divergences within overbought and oversold signals. That's really all I use it for. And also I do apply some chart patterns to the indicator as well. Okay, can you talk a little bit about leverage and margin? Okay, I also have a webinar on this subject where I went through leverage and margin in detail. This can be found again under the resources tab at the main FP webpage. So what I'll do here is try to give you a basic introduction to leverage and margin, because I see a lot of newer traders get very confused with this. They think they're borrowing money from the broker, which is not true. I think that is true in terms of share dealing, but certainly not with derivatives. So look, leverage for the purposes of trading is basically the ability to put on a position larger than your available funds, so your account equity. And for margin, this is expressed as a percentage of the position's notional value. So when I say notional value, I am referring to the position size. You know, for FX, it's very common, 10,000 units for a mini lot and 100,000 units for a standard lot. Margin is a portion of your account that is held by your broker to ensure you have the means to cover any potential losses. Now, to get our initial margin, and this is the margin we have to deposit with the broker, the broker actually takes it from and locks it away, so to speak. Now, to get how much, again, guys, you can use a calculator. I'm just trying to give you how you would calculate it. To get our initial margin, it's a very simple calculation. We simply divide the margin ratio. So if we have a margin ratio of 1 to 100, well, 1 divided by 100 equals 1%. So 1% of our account equity will be taken as initial margin. So if you're trading a $10,000 account and you're set up for you're trading say, I'm trying to think how I'd work that out. So you're looking at $100 margin. It's as simple as that. A common misconception about trading with leverage is that leverage is is that the leverage a trader receives is a loan in CFDs. Now, I guess I can see why many traders believe this, believe it's a loan, largely due to many educators pumping out this as fact. I think they're just trying to explain it in a way that's easy to understand for newer traders, but at the same time, what that's doing is causing more confusion. So the broker for FX spot trading, that is not lending you anything. There's no money being lent. There is no loan. Traders need to stop thinking this. Let me just repeat that so it's clear. Leverage in retail spot FX is not a loan. There is no loan being given. It just makes no sense how a broker could afford to loan out that much money. It would be in the billions. So look, as I said, I cannot tell you how many websites I've seen that state that traders are being loaned money to gain additional exposure. As I said, this is of course unlike share dealing, where you're trading physical shares. You're not trading a derivative, you're trading physical shares. So when purchasing shares outright, that is if you want to own, say Apple or Google, or you want to own $10,000 of Apple, for instance. You'll need $10,000 in your account if you're trading. If you want to own 10,000 plus commissions. So, but I must be clear, a margin facility is actually available available in the stock market. But here when you trade with this margin, you do actually borrow from your broker in exchange for interest paid on the securities. Typically, traders are able to borrow around 50%, I believe, on the stock's purchase price, but this is nothing compared to what you receive in FX in terms of leverage. So spot trading is unique. For one thing, it's in spot FX, the contract you are entering into is not a purchase of physical currency as you would in share dealing. And it's not exactly a futures contract either. It's a rolling spot contract with your broker, rolled each day at 5 p.m. Eastern Standard Time, if of course you hold your trades overnight. This may surprise some here, but when retail traders take a position in the FX market, they do not buy or sell anything. They simply form a contract with their broker, where they believe the next move in the market will be for speculation purposes. I must also say CFDs are always cash settled, unlike futures and options. These are other derivatives which you can, many larger participants may actually take delivery of the underlying asset. So I understand that what I'm saying may be confusing, especially to newer traders, as most market analysts, including me really, refers to going long as buying a currency and going short as selling. But just remember, you as a retail trader essentially set a contract on the direction of a currency pair with your broker, with your provider. You are not buying euros and selling US dollars, period. You are only setting contracts with your broker. I guess I could also say that leverage trading is generally the route most retail traders take in FX. I do know that you can trade unleveraged positions, but I really don't see the point with that. You'd have to have a considerable account. If trading without leverage, you would require, as I said, a significant amount to make it worthwhile, and would not be approachable for small traders. Think about it. You would need, say, $10,000 to trade one mini lot, and $100,000 to trade one standard lot. Although there are retail traders that do trade at this with these type of account sizes, the majority work with equity and account equity, I believe, between $1,000 to around $20,000 I would say. Now look, employing leverage in the derivatives market, such as options, futures, and contracts for derivatives, I'm just going to repeat myself here, are based on contracts. So a derivative is something that derives its value from an underlying asset. With CFD, traders set contracts based on the underlying asset, and cannot take delivery of the underlying asset, as I've already said, as the contract is in place to speculate on the difference between the price we open at and the price we close at. But with futures and options contracts, which are also, as I've said, derivatives, some futures and options brokers do allow investors to take delivery, though I must be clear that this is rarely done. Just finally, just while I remember, each broker has a minimum allowable leverage. As I'm sure most of you already know, for example, we have 1 to 50, 1 over 100, and 1 to 500. Yes, I think FP Markets, now do not quote me on this, you'd have to check with our customer support team, but FP Markets offer leverage of 1 to 500, I believe, on their pro accounts. Though on the retail account, on the retail account, I believe the leverage facility is 1 to 30 now, due to the product intervention from the Australian Securities and Investments Commission. We have a comment here from Ivan. Many futures contracts are dollar settled. Yes, I can imagine that, Ivan. I'm pretty sure the majority won't want to receive 1,000 barrels of oil and things like. Yeah, stock index futures have always been cash settled, I believe. But I was mainly referring to the commodity futures and things like that. But rarely do I hear of anyone taking actual delivery. So to sum this up for the attendee that asked about leverage, I'm sorry to go on a rant about this, but this is something I feel that needs to be out there to traders regarding leverage. So look, for retail spot FX, leverage is not alone. Anyone that tells you this tells you otherwise is incorrect. Now, to further this understanding, let's assume we're trading physical currencies. Bear with me. So in other words, we trade unleveraged transactions, and we have relatively deep pockets. So imagine the euro dollar currently trades at a nice round 1 spot 20, and we want to buy 100,000 euros. We therefore have to deliver. This is an unleveraged transaction, so do bear with me. We have to deliver 120,000 US dollars to receive 100k euros. Now assume euro dollar rallies to 1 spot 21. That's a 100 pip move to the upside. And now I want to take advantage of the euro advance. So what I simply do is deliver my initial 100,000 euros to receive, what will now be 121,000 US dollars. So this is a 1k profit, right? So which is $10 per pip. It's exactly the same. But all you're doing when you're trading on margin, you only pay a small amount of the notional value. So in the example, when we're trading unleveraged positions, we're simply putting up the whole amount. But with margin, you only have to pay a small amount of the notion. You're not even paying for it. You're depositing that amount of the a small percentage of the notional value. So 100k in this example. To trade a 100k contract or one standard lot in FX. So basically, you deposit margin to gain exposure to the same value you would have if you physically traded the currencies. I hope that makes sense. So remember, when retail traders, I'm going to repeat myself, take a position in the FX market, they do not buy or sell anything. They simply form a contract with their broker to trade the underlying market price through the derivatives, where they believe the next move in the market will be. In FX, we do not trade the underlying market, we trade derivatives in the form of contracts based on the underlying market. I hope that's clear now. I know I've really gone over this, but yet, guys, if you're interested in leverage and margin, please do check out the leverage and margin webinar I conducted a while back. Yeah, so if you're interested in that. Okay, one more question we have. What do I think of gold right now? Gold, I'm not sure. Let me just check. The last time I was looking at gold was for the harmonics, the harmonic pattern that's still in play. Oh, it's finished. So I highlighted this. I'm not sure if anyone remembered this on Twitter. I was looking at this Gartley pattern here. For anyone that trades harmonics, this is a very popular harmonic formation with the 78.6% Fibonacci retracement ratio being a very important level within the formation. So as you can see, price has reacted from there strongly, and the 38 commonly, if you follow the work of Scott Carney, commonly the 38.2% Fibonacci retracement ratio taken from A to D is looked at as the initial take profit target, with the 61.8% Fibonacci retracement being the second and usually final take profit target, depending on the trader, of course. As you can see, price recently hit that level looks like to the point and has rallied. So this was a fantastic trade. So for now, I don't really have an opinion on gold in terms of where I think it may go, but it looks like we are heading potentially higher, especially if we do break this this high around the 1815 level, as we have very little in terms of areas above here, so it's pretty free to rally back up to this to the Gartley patterns PRZ. Okay, guys, are there any more questions other than what's already been asked? Let me just check. Okay, nothing. Okay, brilliant. Look, thank you so much for taking the time out of your day to be with us. I hope you found it useful. Let me just check. Yes, so if you have any comments or feedback regarding the presentation, do send them to either Market Analyst at fpmarkets.com. This is the research team's direct email, or essentially, or alternatively, send any comments or feedback to support@fpmarkets.com. Yes, so thank you very much for taking the time out of your day to be with me. I hope you found it productive, and yes, I'll see you all again very, very soon. Thank you very much. Goodbye.